that people don't realize that the last 2 weeks have been very unusual and really abnormal. To see things like the 2-year go up 25, 30 basis points and the next day go down 30 basis points, this is not normal. And to see some of the challenges on some of these banks, and maybe they're not systemically important, but the point is they're big banks. To see them and have essentially runs on the bank or essentially deposit vigilantes moving the banks, I really think everyone should recognize all of these items I mentioned are the symptoms of the larger problem. And that larger problem is the Fed has been raising rates too far, too fast, and they are now feeling the need to keep going when all the leading indicators, whether it's leading indicators, whether it's money supply growth, whether it's shape of the yield curve, are really flashing to slow down, that in fact a recession is going to be upon us. And I think the fact that they raise rates yet again is going to be a big mistake. They should not only stop raising rates, they should also stop quantitative tightening as well.
But hang on a minute, though, Gilbert. We've known that the Fed has embarked on its fastest pace of tightening in decades since last year. We know that 450 basis points of hikes are in the can. And at some point, the variable and lag impact of that tightening is going to hit. So is it really any surprise that we are seeing tighter credit conditions?
Sure. The answer is, I believe so, and here's why. If you go back just to the fourth quarter of 21, what was happening? Inflation was already running year over year at 6%, and yet here we were, quantitative easing, being very aggressive, and all of a sudden here we are again, inflation is roughly 6%, and we've raised rates to the top of the range already 5%, quantitative tightening, and then some. And so in my view, if you look at most of the inflation indicators, they're all rolling over. If you look at CPI, some of the biggest components, of course, are gas. That's rolling over significantly. Food has rolled over significantly. Housing, that's lagging some, but it's already starting to roll over significantly. And autos. So a lot more data is now, what's different to your question, a lot more data is proving that they are successfully getting inflation down and contained and controlled, which is why they should already stop raising rates, stop the quantitative tightening, and let things settle down. And let's see where it goes. Because all they're doing by continuing to raise rates is they're going to wreck something, whether they're going to wreck the banking system or whether they're going to wreck the economy, but they're going to break something.